I'm most interested in hearing what guidance is for the third quarter, more so than I am about the second quarter. Second quarter earnings will be fine. But what do people and companies have to say about the impact of tariffs? And you don't have to be a manufacturer, an industrial company, to talk about the impact of tariffs. Any service business does business with the manufacturer, and maybe they get affected too. Now, maybe it's too early to really gauge. Maybe it's too early to quantify. But I think that's the most important thing as we hear earnings over the next couple of weeks.
And it seems like, Steve, there's a debate on Wall Street right now about what that guidance is going to look like. The optimists say 20% plus earnings growth. Companies are investing. Confidence is high. They're hiring like they haven't in years. So guidance should be good. Also, there's the Peter worry about trade and.
Well, at least that is the story. But Peter brings up a valid point. But I do think his last point, I think it's too early to tell because you don't know what those tariffs are going to be. So you can't quantify them yet. You can give a little bit of guidance around them, but I don't think it's anything firm. More importantly, 2,800. Mike's talked about that. 27.92 was a retracement level. We closed slightly above it a couple of days ago. Now we're knocking on it again. Resistance, the more you knock at the door of resistance, the weaker it gets. I would believe that with 25% of the XLF reporting prior
Financial
to
sector,
exactly.
ETF, yeah.
You have J.P. Morgan, you have Wells Fargo, you have Citi. Together, they're roughly 25% of the XLF, the ETF of the financial sector. You have to cover this market. We saw that sell-off. We saw everyone worried about the inverted yield curve. We saw them sell off financials. But prior to tomorrow's opening, when you get these companies that should perform pretty well, you should see the market overtake that 2,800 level.
Rick, we did get, of course, the CPI report this morning. Some elements of it looking a little bit hotter than expected in the year-over-year number, higher than it's been in some time. But what's your take on how the markets are absorbing that and really how to characterize that as part of this overall trend? You see, bond yields still pretty range-bound, but lifting just a touch today.
Yeah, absolutely. All I need to do is look up and see where a two-year note is. The two-year note yields paid close attention to the last couple of days' worth of inflation data. The rest of the curve, not so much. So what it boils down to many traders is that Jay Powell is going to look at the inflation data and most likely continue tightening. Now, everybody that's nervous about inflation would say that's the way to go. Will it invert the curve? It certainly looks like that's a possibility. If he goes slower, which many of the administration want. Larry Kudlow expressed, slow is better. If he goes slow and inflation continues to ramp up, they find themselves in the box where they have to pay catch-up. So no matter how you slice it, there is no place to hide for the Federal Reserve. Removing policy accommodation is going to be difficult for us. It's going to be nearly impossible for the other central banks.
What's the expectation in the stock market and the bond market, for that matter, Peter, as far as what the Fed is going to do and how they would react to this escalating trade fight?
Well, I think the stock market is not going to react until the problem is right in front of their face. Markets are now more reactive than a discounting mechanism. And until the stock market sees it actually in corporate earnings and sees it in the hard economic data, I don't necessarily think they're going to react. Now, whether that's the right thing or not, that's a different thing. But that's what I think the stock market would respond to. Now, to the inflation point, the inflation numbers we saw today is before we will see rising transportation costs filter into higher consumer prices, and before tariffs filter into consumer prices. So, as to Rick said, it'll keep the Fed continuing to raise interest rates. Loretta Mester in the Wall Street Journal said she wants to raise 2 more times this year. Harker, on the fence, maybe would be willing to raise 2 more times this year if the inflation numbers continue to tick higher, which I expect them to.
Steve, it would seem that the stock market would react to the tariff stuff before we even find out if it gets into earnings, if other markets around the world were upset somehow. And you saw some kind of volatility spike in emerging markets, in the currencies, in something that tells stock investors, okay, there's a disturbance here.
Right. And when you look at the returns that we've seen in those other markets, they've been subpar to what the United States markets and the U.S. Indices have been. So I think people are still coming here before they start to go abroad. But there's going to be a huge buying opportunity at a certain point when you see Turkey down 30%, 35% year to date, when you see the heavy EEM, heavy Asia influence, there's going to be a buying opportunity, and I think we're really on the precipice of that happening. I do believe that the best market.
Is it going to be on the Fed or on trade headlines?
I think it's going to be on probably both, but I would say that it's got to be on the trade headlines first. So if we see anything that is subdued to what the rhetoric is right now, and I do believe we're getting there, and I do also believe that the Fed will back off a little bit. We heard Powell's statement today that inflation is not at his target yet, so I think they're leaving the room a lot more empty for the doves to take the replace of the hawks.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.